Okay, we are at chapter 18. This chapter is introducing you to tools that can be used to analyze financial statements. Throughout the course, you have learned how transactions are recorded into the accounting system, how the accounting system summarizes them and produces these financial reports. So the financial reports are reporting how the company did financially. The question is how do we use them? And these tools that we're learning in Chapter 18 can be used to help evaluate how a company is doing financially. Okay? So the first problem we have here is financial information for Blevins for the year ended 2011 and for the year ended 2010. We will be preparing a horizontal analysis. So we have very condensed balance sheets here. We have them very simplified. Obviously, not all accounts are detailed, but we're just going to work with the simplified version because it is really more about applying the tool. And in a horizontal analysis, we are taking one portion of the financial statement or one line item or one category and comparing from year to year. Okay, so essentially we're horizontally over time comparing the change in specific items. And here we're using a balance sheet to apply the horizontal analysis. It can also be used on income statements, okay, or the statement of owner's equity or the statement of cash flows. So we're just using the balance sheet as an example. All right, looking here, these numbers are just being brought down out of the initial problem information. We are going to complete these balance sheets. So over here on the right, I have the completed balance sheets. So here we have the current asset amounts and the planned asset amounts to get total assets, the current liabilities for the 2 years to get total liabilities, then the common stock and retained earnings for the 2 years to get total stockholders' equity, and then adding in stockholders' equity and liabilities. Okay. Once we have the two balance sheets side by side, we can apply the horizontal analysis, and it's very simple to do. In horizontal analysis, we will compare the base year, and the base year is always the first year presented. So here, 2010 is the first year presented, so it is the base year. Take the dollar amount of change from the base year to the year that it is being compared to. The dollar amount of change from $100,000 the base year to 2011, 125 is a total dollar amount of change of 25,000. We then calculate the percentage change, and the percentage change is calculated by taking the amount of the change divided by the base year. So here we're seeing 125,000 minus 100,000, we have a dollar change of 25,000. If I divide the dollar amount of change by the base year, the first year presented, I have a 25% change. Do the next line item, total net assets. Dollar amount of change from 2010, the base year, to 2011 is $66,000. Divide $66,000 by the base year or the first year presented, we have a 20% change. Total assets, 430,000 to 521,000 is a $91,000 change from the base year to 2011. Divide the dollar amount of change by the base year, 430, to get a change of 21.2% for total assets from 2010 to 2011. We do the same thing for each line item in current liabilities. Dollar amount of change from the base year, first year presented, to 2011 is $21,000. Divide $21,000 by the base year, first year presented, which is $70,000. We have a 30% change. So we are doing this line by line by line. Okay. Here we're seeing a decrease in retained earnings from 2010 to 2011. So that's why we're seeing a negative number here. If we take the negative 14,000 and divide by the base year presented, $150,000 the first year, we got a change of a decrease of 9.3%. So that's what those brackets mean, okay? That is applying the horizontal analysis. Now, what do we do with it? Just doing the analysis or the horizontal portion of it, the calculations is step one. Second step, and where the horizontal analysis actually means anything, is when we start analyzing. So what we can do, and it's hard to do in the educational setting, managers or investors or creditors would take a look at these changes and try to determine if these are positive, if they're negative changes. Is this something that was expected, or is there anything here that's unexpected? Is there anything in here that sticks out as being a problem? Okay, so that's what we would do with this. In this next problem, we are going to look at another financial ratio tool or financial analysis tool, and that is using vertical analysis. So here we're working with Gallup Corporation. We are given selected items from the income statement, and I want to kind of emphasize here, in the prior problem, we worked with horizontal analysis applied on the balance sheet. And here we are going to apply vertical analysis to the income statement. And I just kind of want to emphasize that these tools can be used on any of the financial reports. So we just happen to be applying them to two different types of reports, balance sheet and income statement. But these tools can be used on any of them. In other words, vertical analysis can be used on the balance sheet or the income statement or the statement of cash flows, etc. Okay. All right, so they have given us information for an income statement. They want us to prepare it into proper income statement form. So proper income statement form is to take sales less of cost of goods sold to get to gross profit. And so that's what we're seeing over here in the solutions. Then we subtract out our selling and administrative expenses to get to our total operating expenses, calculating income before income taxes, then subtract out the income tax expense to get the amount of net income for the year. What vertical analysis does is, instead of looking across years, okay, even though we have 2 years presented here, the analysis is going to be done within each of the years. For example, in 2010, we are going to use our sales as our base amount. Okay, this is the amount that we're going to be basing all of our percentages off of. So if we want to know each line item in the income statement, what percentage of sales it is, we are going to divide each line item by the amount of sales. Sales divided by sales. Sales are 100% of themselves, obviously, right? So then let's look at cost of goods sold. 390 divided by sales. Cost of goods sold is 65% of the sales. Gross profit, 210,000 divided by 600,000. Gross profit is 35% of total sales. Selling expenses are 72,000 divided by 600,000. Selling expenses are 12%. Administrative expenses, 54,000 divided by total sales of 600,000. Oops, let me get the right. 9% of total sales. So ultimately what we're doing is we're taking each line item as a percentage of sales, figuring out what each line item's percentage is of total sales. In other words, this helps us look at it and say, you know what, for every dollar in sales, 65% of it, or 65 cents, goes to cost of goods sold, leaving 35% or 35 cents on every sales dollar as profit. And that 35% covers a 12% selling expense, 9% of sales dollars go to administrative expenses, leaving an income on every sales dollar of 14% or 14 cents. Income tax takes up 4 cents of every sales dollar, leaving us with ultimate net income of 10% on every sales dollar, or we earn a profit of 10 cents on every dollar in sales, once we subtract out all of the expenses that we incur. Okay. We would come over here and do the same thing for 2011. The base year, the base amount would be 2011 sales of $750,000. Taking each line item, $465,000. Oops, sorry, didn't mean to do that. I meant to do that over here. $465,000 divided by 750,000 in sales. Cost of goods sold is 62% of each sales dollar. Gross profit, 285,000 divided by sales of 750,000. Gross profit is 38 cents of every sales dollar. Okay, so we would do the same thing within 2011. So vertical analysis is going vertically within the financial statement, figuring out what each line item is as a percentage of their base amount. And then we can look at year to year improvements. Maybe we look for some negative trends, but ultimately looking at overall, how did we do comparatively year to year? 2010, we had a slightly higher profit for every sales dollar than we did in 2011. Okay, so this just kind of helps us direct our attention to where we might need to look at things that are wrong, or maybe where we need to look at things that are going well, or investors might be able to use this to help them analyze how the company is doing financially. The last type of financial analysis tool that we are going to look at here are financial ratios. Okay, financial ratios are great for looking at specific areas of a company's financial situation. We can break out ratios into profitability ratios. We can look at them in terms of their ability to pay debt as it becomes due, liquidity, or we can look at their financial position. Are their assets producing profits? There's different ways we can analyze different aspects of how a company is doing. So to show the application of different types of ratios, and there's a bunch out there, we are going to work with just some of the very basic. So in order to do that, we are going to work with this problem. There is selected financial data presented for Target as well as for Walmart. So here we have two competitors working side by side, looking at their income statements, and notice that all of these numbers are in millions, which means they have just dropped the last three numbers here just to simplify the financial numbers we're working with. But here we have income statement information for the year and balance sheet information for the year. Okay. They also gave us some additional information here, some beginning of year balances, because remember, all of the balances reported in the financial statements are end of year balances, and we are probably going to need some beginning of year balances to do some of our ratios. They have also calculated some averages for us that we will be using to prepare our ratios. So when we prepare ratios, we are using the information presented in the financial statements. Okay, they're going to have us prepare or calculate a whole series of ratios for both companies. The first one we're going to calculate is called the current ratio, and I put in here the ratio formula. The current ratio is calculated by taking current assets and dividing by current liabilities. Assets and liabilities are reported on the balance sheet, so I can pull this information from the balance sheet. Here we have current assets for Target and current assets for Walmart. Here are current assets for Target and current liabilities for Target and current liabilities for Walmart. To calculate the current ratio, we will be dividing the total current assets of Target, 18,906, by the current liabilities of Target. When I divide 18,906 by 11,782, I come up with a ratio of 1.6. What this is saying is for every dollar in current liabilities, Target has $1.60 or 1.6 in current assets. We want to see a current ratio higher than 1 because that means their current assets are greater than their current liabilities and they're prepared to pay off their current debt as it becomes due. Calculating Walmart's current assets of $47,585,000 divide by current liabilities of $58,454,000, they have a current ratio of 0.8. In other words, for every dollar in current liabilities, they only have 0.8 or 80 cents in current assets. So based on comparing these two ratios to one another, it looks like Target is in a much better position right now to pay off its current debt as it becomes due. Now let's do the receivables turnover. It is calculated by taking net credit sales and dividing by average accounts receivable. That means what was the average amount of accounts receivable they had during the day or during the year. All right, here is net sales for Target and net sales for Walmart. And I think they already calculated average net receivables for us down here, so we don't need to calculate the average. We will take the total amount of net sales divided by the average assets for Target and do the same for Walmart. 8.6 receivables turnover for Target, 115.3 for Walmart. That is measuring how quickly they are turning over their receivables that they are taking in as over sales. Obviously, a quicker turnover, the better. We want to see a lower or a higher amount of dollar sales over their receivables. Means they're more efficient in collecting on their credit sales. The average collection period is going to take the result from receivable turnovers and divide it into 365 days. So this ratio is calculated by taking our result from receivables turnover and dividing it into 365. What this is telling us is that the average time to collect on Walmart's receivables is 3.2 days, whereas Target's is 42.4. So it appears that Target is a little less efficient in collecting on their receivables than Walmart. Inventory turnover is cost of goods sold divided by the average inventory. They already calculated an average inventory on hand during the year for us. And our cost of goods sold is up here in the income statement. If I divide those two numbers, 41,895 for Target and 286,515 of cost of goods sold for Walmart by the average inventory for both that was given in the problem, we are getting an inventory turnover of 6.4 for Target and 8.3 for Walmart. We obviously want to see inventory being sold a little bit quicker because a quicker sale because inventory costs are expensive for warehousing and maintaining and all that. So Target does a better job of turning over its inventory than Walmart. They're able to reduce their inventory costs a little more. Days in inventory measures how many days the inventory sits around before it is sold. 365 days divided by the result from our inventory ratio. Here we're seeing that Target's days in inventory are 57, whereas Walmart's are 44. Okay, so Walmart has their inventory on hand a little less number of days than Target does. The profit margin ratio is calculated by taking net income and dividing by net sales. All of that information is in the income statement. Net income for both companies and net sales. Taking net income, dividing by net sales for both companies. Target's profit margin is 4.6% and Target's is 3.4%. It appears that Target has a higher profitability on every dollar sold than Walmart does, but they're still pretty close. They're pretty much within industry standards. The asset turnover Take net sales divided by total average assets. Net sales is here, and I believe they calculated average net assets for us. Maybe they didn't. Maybe we need to calculate it. All right, so here is net sales for both companies. Return on assets. So here are our net sales. To calculate the average net assets, the simple way to do it is to take total assets for the beginning of the year. So here it is for target of 44,560. Sorry, that's the end of year total assets. And where did they give us? Oh, here is the beginning of year. So if we take the beginning of year in assets, add it to the end of year assets, and divide by 2, gives us a rough estimate of the year's average in assets. And so that's where they're getting that average assets from. So dividing the net sales by the average assets, we would do the same thing for Walmart. We would take their total assets at the beginning of the year and add them to the end of year. So here's end of year assets on the balance sheet date. Here are beginning assets at the beginning of the year. Add those two together and divide by 2 to get a rough average. That gives us net sales divided by the average assets, an asset turnover of 2.4. So it appears that Walmart is doing a little bit better of their average assets generating profits. The assets are turning over. In other words, we're earning the cost of those assets 2.4 times, whereas for Target, it's only 1.5. Return on assets is going to take the dollar amount of, where is it, net income, and divide by that same total average assets for the year. Net income right off of the income statement. Divide by, that's the wrong one, the average assets that we used in our asset turnover ratio. Remember, we calculated those average assets by taking the beginning of the year assets, adding in the end of year assets, and dividing by 2. That was shown down here. We have a return on assets of 7% for Target and 8.1% for Walmart. It looks like Walmart is a little bit better at purchasing assets that are generating revenues, just slightly a little bit more, 1%. All right, next one, the return on stockholders' equity, on common stockholders' equity, is going to help us evaluate how well owner investments are providing a return. So in order to do that, we will take net income, subtract out any preferred dividends, and then divide by average common stockholders' equity. Easy part is the amount of net income. That is given here. Down here, it looks like they gave us the beginning of year values for stockholders' equity. So in order to get the average common stockholders' equity, we will take the beginning of year balances for both of those, add in the end of year balances for total stockholders' equity. That's where these numbers are coming from. Okay. The beginning of the year given down here, plus the end of year given in the balance sheet for both companies, and then dividing by 2 to get the rough average for the year. And that ends up being divided into the net income. And since the problem didn't tell us anything about preferred dividends, we are going to make the assumption that there were no preferred dividends that need to be subtracted out. Okay. Calculating that, we have an 18.4% return on common stockholders' equity for Target, and for Walmart, 20%. So Walmart is providing a little bit better return on stockholders' investments. Okay, the next ratio is going to have us comparing total debt to total assets. Recall previously we worked with just current assets and current liabilities to evaluate the ability to pay off current debt. But down here, we're looking at their ability to pay off their total debt overall. What that will do is take into account the total liabilities of each company, both current and long-term. Okay, and so that's what we need to add those two together to get their total debt. That will give us their total liabilities, and we will then divide by the total assets for both companies. All right, here we go. We see total debt for Target is the current plus the long-term, which those numbers aren't there. I'm not sure where they showed the calculations, but if we were to add the total current liabilities and total long-term debt, it should equal 29,253. We divide by total assets, 44,560, to come up with debt to total assets of 65%. For Walmart, add up the total current and long-term liabilities to get total liabilities, divide by total assets to calculate 60.5%. In other words, it looks like Target has more debt as a percent of their assets than Walmart. So overall, Walmart is a little bit better financially positioned than Target, but still not a whole lot. Right, the final financial ratio helps us evaluate how well the company's interest costs are covered by their income. So really, the interest costs that they incur on borrowed funds, we want to make sure that their income is sufficiently covering those interest costs, which requires us to get net income before any interest or income tax expenses have been subtracted. Because net income is always reported after income tax and interest expense have been subtracted, we're going to add those amounts back. So for Target, net income of $2,849,000 plus income tax expense plus interest expense, add those together, it would come to $5,272,000, and then divide by interest expense of $647 million to get 8.1 times. Then we would do the same thing for Walmart, net income plus their income expense, income tax expense plus their interest expense to get 21,437, and then divide by the amount of their interest expense to calculate 11.9 times. Thus, Walmart is earning their interest expense, or their income is covering their interest expense almost 12 times, whereas Target's is only 8. Which tells us that Walmart's a little bit more efficient with their borrowed funds in generating net income. Okay. Now, ultimately, it's really hard to fully analyze the results of these ratios. In the educational setting, we're kind of focused on how do we calculate them, and then the analysis really is about comparing from one company to the next, or comparing a company's results from year to year. That enables us to look for positive trends or negative trends, or how are they doing compared to competitors, and so on and so forth. So hopefully that helps you just kind of understand the tools available to analyze financial reports. Please reach out with any questions.